This is the part of the show where we put a fund in the spotlight, and this week we're reviewing the Segregated Bond Fund, and it's managed by Rowan Williams-Short. Cobie.
Eleni, this is a segregated bond fund. That means it's an off-balance sheet type fund which is managed on behalf of a specific client. As I said, my manager here is Rowan Williams-Short. The formation dates about August 2007. There is a longer track record over here, but it's probably broken up in time going back. The objective here is the ALBI, which is the All Bond Index, and the total expense ratio is negotiable. Just give you some return numbers there. 1 year, 12.5 versus 11.3, 2 years 12.4 versus 10.6, and over 3 years 14.2 versus 13.4. Those numbers are obviously per annum numbers. Let's just have a look quickly and let's bring up the chart again of the returns. This is the first time around we're looking at a bond fund, and obviously the returns are more compressed than what they are for equities because equities are more volatile. And you can see this period here in 2009. Look how the All Bond Index continues to build and build and build as there continues to be panic buying specifically of bonds. You can see the outperformance of the fund, which is the blue shaded area, dwindles slightly, and as the market kind of corrects itself, you see the outperformance becoming better and better. Very similar to the period that we saw over here. Over time, long-term outperformance over the ALBI. Eleni, back to you.
Okay, so Rowan, your comments on this fund, you have been doing quite well, if I may say so.
Well, that's very kind of you. This is a composite of some segregated funds, so it's not cherry-picking one that did well. Just to tie it in perhaps to the earlier discussion, I do believe that it was market inefficiencies that were harnessable, if that's the proper word, in order to achieve these returns. The two episodes that I'll mention, obviously a lot happens over a 4-year track record, but the two primary episodes were back in December 2008. You may recall all the talk in the markets at the time, and I'm sure on your television station as well, were flight to quality. And so the market was spooked by the whole subprime episode and said equities, emerging markets, currencies, commodities are a disaster. What we all need in the world are government bonds, most notably US Treasury bonds. Well, that happened, and it caught on to such a great extent, captured many gullible people, that it drove yields to absurdly low prices. Now, without making a forecast, it was possible to show, and I did it in December 2008, that the market in South African government bonds was implying that inflation for the next 10 years would be negative. Now, that's just naive and implausible. So in other words, managing this by, in technical terms, taking a short duration position was fairly easy. Another consequence of the credit crisis was that spreads on anything but government bonds became extremely wide, something like we're seeing in Greek government bonds right now. And South African corporate bonds offered their most attractive ever up till that point, and possibly at least for the next 20 years. And again, as long as you were prepared to go against the grain, to go against conventional wisdom, you could harvest these spreads very attractively. And those were the two big episodes that led to the good performance of these funds.
Okay, so you're still going against the grain?
I will do that till my dying day.
What are you doing right? Are you buying Greek government bonds?
If I had a global mandate, I absolutely would be filling my boots with Greek government bonds.
That's a brave man.
We'll just wait for the Germans to bail them out. Maybe I'm being parasitic now.
They've just bailed them out, so it's too late.
Not yet. The paperwork hasn't officially been done.
2-year yield of 36% in euros on Greek government bonds. I would be doing that, absolutely.
Okay, so is that the silver bullet, Roland, to be completely against the grain? Look at what people are doing. If everyone's buying resources, sell resources.
Well,
if everyone's selling, buy.
If everyone's against the grain, everyone's doing the same thing. You see, this is the problem with value investing. Like, everyone says they're value investing and they're contrarian. They can't be contrarian if they're all doing the same thing.
Okay, interesting. Okay, so Rowan, you were talking about some of the periods, and we know you mentioned in 2008. Take us back to, for instance, 1929 to 1932, when we saw the Dow Jones losing 89%.
Yeah, I thought we might wrap up this discussion by bringing it back to a few cases which I hope are on your screen. I see they are.
Yes, they are.
I mean, here's some fabulous episodes to show that inefficiency doesn't just happen in emerging markets or in small capitalization shares. Here's a bunch of well-known assets, and the drawdown means the worst streak of losing from peak to trough. Dow Jones 1929, minus 89%. I think the second one is even more shocking. After inflation, the return on US government bonds, treasuries, over a 40-year period was minus 67%. Now, no academic could stand there saying markets are efficient, looking at these kinds of numbers.
Absolutely.
And the very last one you see is recent Japanese stocks. And might I say, to just bring in behavioral finance one more time, you see the NASDAQ collapse from 2000 to 2002 of 78%. You would think that human beings would learn from these episodes, wouldn't you? And that the kind of collapse that you saw before won't happen for at least another generation. I put it to you that the recent listing of LinkedIn suggests we learned nothing from the TMT disaster just 10 years ago.
Social media bubble might be playing out. I'm glad we've got two very opposing views here, and they're sitting on opposite ends of the desk, but that's what essentially makes the market, right?
For every winner, there's a loser.
Fantastic. 2 seconds to wrap up. Cobie.
Have cash will make money. Make sure you've got cash at the bottom of the cycle.
Fantastic.
I'll return it the other way around. For every loser, there's a winner.
Fantastic. Gentlemen, we have to leave it there. Thank you so much. It was a pleasure having you in studio with me.